morning, everyone, and welcome to Morning Markets here at True Potential. So we start with focus on global equities. So an encouraging day yesterday. News that China is beginning to reopen from their latest COVID lockdowns added early momentum in Asian hours, and then strong employment data from the UK, and then strong retail sales from the US added further momentum through the rest of the day. Now, the main economic update for this morning is UK inflation for the month of April. Updated CPI numbers show UK prices rising at roughly 9% year on year, and this confirms the UK as having the highest inflation pressures of G7 economies. Now, this is important for a number of reasons. Firstly, UK inflation is accelerating faster than the take-home pay of UK workers. So this exacerbates the squeeze on household incomes, and when adjusted for inflation, it means real take-home pay is actually negative. This reduces the buying power and contributes to this squeeze. Secondly, underlying inflation pressures in the UK are very broad-based, and this makes it difficult for households to alter their spending in a way that they can alleviate these price pressures. The prices of energy, transport, food, and recreational activities are all accelerating, and it's extremely difficult to expect any individual or family to avoid spending on most of these items, and this just exacerbates this cost of living squeeze. In addition to UK consumer prices, we also had inflation data for UK businesses, which showed an even greater level of inflation in both input and output prices. Now, this in particular shows the dominance of energy and goods costs in UK business models. Now, what are the market consequences of high UK inflation? Well, they're quite varied. Firstly, the pound is likely to remain quite weak versus the US dollar. The UK is an importer of both food and energy, and so this means that our currency will need to rebalance and adjust for this. Secondly, the Bank of England are likely to continue raising rates over the summer. Now, they may not raise rates as much as markets expect. The base rate, recall, right now is 1%. Markets expect the base rate to get to 2% by the end of the year. We think that's perhaps a little too aggressive, but there may be further modest increases in interest rates over the summer. The employment data that was published yesterday for the UK and was discussed by my colleague George Bell demonstrates the strength of parts of the UK labour market. But together with the higher inflation data, higher borrowing costs from the Bank of England are likely needed to cool inflation pressures into the end of the year. Now, finally, for cash savers, this inflation data means that your real level of savings is actually negative. And given that inflation is likely to accelerate further before the end of the year, doing more with your money has never been more important. Now, that's all for today. Please join us tomorrow for a further market update. Thank you.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.